The strength of the global economy is currently varying by region. For example, the world's largest economy, the United States, experienced a period of quite impressive expansion, with third quarter growth nearing 5%. This was largely attributed to strong consumer spending, which seems at slight odds with what one may expect given the severity of the interest rate increases over the last 18 months or so. Elsewhere, however, growth has not been nearly as impressive, with the UK and Europe stuttering along from month to month and slowing slightly in the third quarter and indeed in October and November. Unlike the US, both services and household spending saw declines here in the UK. Further afield, China is disappointed on expectations but continued to post positive growth, helped latterly by government and central bank economic intervention, including interest rate cuts. These actions have been prompted by a number of factors, not least weakness in the country's debt-laden property market. Inflation figures for the major Western markets continued to fall during 2023, with the November print for the UK and US reading 3.1% and 3.9% respectively. This is significantly lower than the beginning of 2023, where figures were closer to double digits, and makes the feared 70s-like inflation scenario now seem highly unlikely. Against this backdrop, central banks took the liberty to leave rates unchanged. The market viewed this as being the end of the interest rate hiking cycle and began to pricing in interest rate cuts as soon as early 24 for the US and mid-24 for the UK. This was a positive way to end 2023, with both equity and bond markets performing strongly. However, one can't help but feel that perhaps the market has once again got a little ahead of itself. While we believe we're at or near peak interest rates, we're not being complacent enough to suggest that the war against inflation has been completely won and that a recession has been avoided, especially due to the lagged effects of higher interest rates. Specifically, within fixed income, we maintain a reasonable level of sensitivity to interest rates, which, if cut, possibly on the back of stronger recessionary indicators, should provide an attractive level of return given the yields now on offer. Within equities, we're not positioned aggressively, but retain what we would term a neutral level of exposure in portfolios. Medium and smaller sized stocks in many regions have found themselves overlooked in recent years, not least in the UK. Therefore, should markets continue to broaden further beyond a select group of favoured names, this could prove supportive to returns.